America was at the peak of its prosperity. But by 1933, the banking system had completely collapsed. 1 in every 4 workers was unemployed, and agricultural prices had fallen by 2/3. Factories stopped, homes were foreclosed, and the structure of American life began to fall apart. The disaster was so deep that we still call it simply the Great Depression. It was a period of massive financial cleansing, a time when billions of dollars in savings and generational wealth were wiped out. But here's the often ignored truth. While the American middle class was financially ruined, the share of wealth held by the richest 1% barely changed. In fact, their capital showed a remarkable structural resilience. How could the greatest economic collapse in modern history destroy the savings of millions, yet leave the wealth of the rich mostly untouched? This is the story of the Great Depression, not as a political event, but as a mechanism of wealth transfer, a masterclass on how leverage, deflation, and preparation decide who survives a crisis and who gets wiped out. The roots of the Depression were planted long before the stock market crash of 1929. The first shock came from World War I, which disrupted the global balance of power and forced nations to suspend the gold standard. When the US, Europe, and Japan tried to return to it in the late 1920s, it created extreme rigidity in financial markets. So when the stock market crashed, this rigid system accelerated the fall into a global depression. Deflation, the constant fall of prices, became the ultimate enemy of the middle class. As prices dropped, debts grew heavier. A farmer who had borrowed $10,000 when wheat was high now had to sell 3 times as much wheat just to make the same payment. Industrial production fell by 47%, wholesale prices by 33%, and the value of homes, farms, and factories collapsed, while the dollar amount of debt stayed the same. Then came the banking panics of 1930. Thousands of banks failed, wiping out generations of savings. There was no deposit insurance back then. If your bank failed, your money was gone. The middle class, relying on bank deposits and leveraged assets, was destroyed by the double blow of deflation and bank failures. Yet in the middle of all this chaos, the richest Americans remained stable. In 1929, the top 1% owned 48.2% of the nation's wealth. By 1939, after the worst of the Depression, that share had only dropped to 41.2%. How was that possible? 2 main reasons: low debt and high liquidity. The ultra-rich had little or no debt, large cash reserves, and owned real unleveraged assets. While everyone else was forced to sell, they held steady. And when prices hit bottom, they bought. The wealthy held assets that served as safe stores of value: gold, real estate, government bonds, and treasury bills. These didn't collapse like stocks or debt-heavy businesses. They kept their purchasing power, and when the economy recovered, so did they, stronger than before. The Great Depression was a liquidation, not just a collapse. It was the destruction of weak, debt-heavy wealth, and the survival of strong, structured capital. And that same pattern has repeated again and again, including in the 2008 financial crisis. In 2008, speculation, bad loans, and weak regulation built a mountain of debt. When it collapsed, the wealthy lost on paper, but government bailouts and market recovery funneled wealth back into their hands. Those who owned assets recovered quickly, while the average worker, whose net worth depended on a single leveraged asset, their house, was left behind. 3 timeless lessons of wealth. 1. Avoid debt and stay liquid. Debt amplifies losses in crises. Cash and flexibility save you. 2. Own real, debt-free assets. Gold, cash, and real estate preserve long-term value. 3. Survive to acquire. Don't aim to avoid all losses, aim to stay alive when others are forced to sell. The Great Depression tested the financial foundation of every household. The question today is your wealth built like the fragile, over-leveraged fortunes that vanished in the 1930s, or like the durable capital that survived and bought the recovery? If this historical analysis helped you understand how money truly works, make sure to like this video and subscribe for more insights into the timeless laws of wealth. And tell us in the comments. Besides gold and cash, what debt-free asset do you own to protect your wealth?